You know that feeling when someone shows up for you just when you need it most? That's what Uber is all about. Not just a ride or dinner at your door. It's how Uber helps you show up for the moments that matter. Because showing up can turn a tough day around or make a good one even better. Whatever it is, big or small, Uber is on the way. So you can be on yours. Uber, on our way.
Reality radio for a really great future. We're talking real money.
You know, and there's a reason why I give out the phone number most of the time here on Talking Real Money. That's because Tom always gives out the wrong one.
Yeah, well, so apparently I don't want people to call in, so I guess.
855-935-TALK. That is our number. That's what you use. And by the way, while it works great while we're live on Saturdays from noon to 2 Pacific, 3 to 5 Eastern, it also works 24/7 to call us and leave questions electronically, verbally.
And you can send email. For those of you who just feel kind of shy, don't want to be on the radio, you just send it to Don. Yeah, very easy.
.com. You can also send them in via Talking Real Money, the contact form. We have more ways to contact us.
Even with the low clouds today?
Yeah, you could pull it off in Florida and see it. I don't think you could there.
Be tough today.
I don't see that happening. I've been doing this for a long time, and I want to understand why we keep hearing about people doing dumb things with their portfolios, wanting to speculate here in the market or whatever it is. And then I see somebody like Warren Buffett, and we all want to think he's this brilliant investor. But is he really?
Well, I mean, he's, touted as the greatest stock picker of several generations, right? I mean,
is he really?
Yeah, I mean, and by the way, for those of you who think he probably is, he would tell you, he's already told his wife this, after I'm gone, just own an index. They're really...
Yeah, he says the S&P 500, which we think is silly.
Yeah, but so when you got up today, you might have seen the headline that Berkshire Hathaway, this little firm he runs out of, I think it's Omaha somewhere.
Yeah, they kind of just buy other companies. It's like a giant mutual fund.
It is indeed. Lost $50 billion with a B dollars in the first quarter. I mean, that's a lot of money to lose in a quarter for anybody, frankly. But Buffett, this is part of the process. The things he owns, railroads, utilities, energy, insurance, banks, had a very difficult quarter.
Most of his money, this is exactly what we preach against doing. The bulk of his money is in just 5 stocks.
What percentage of the Berkshire Hathaway portfolio?
Stocks. It's like, I have to find the number. I think it was like 80% was in these 5 stocks. Apple, which lost him $17 billion.
Thank you very much.
Bank of America, which has lost him $12.3 billion. American Express, which lost $7.8 billion. Coca-Cola, $6 billion. Wells Fargo, $6 billion. Whoa! Do you see why we suggest against owning individual stocks?
Concentrated positions.
And when people praise his incredible performance, well, guys, his average annual return for the past 5 years has only been about 4.5% per year.
I think if you bought an index of U.S. large value companies for the last 15 years, you'd have done better than owning Berkshire Hathaway. By the way, he also has $137 billion in cash on his balance sheet. So if things look bad, you got a kind of couple bucks sitting around to make sure lights stay on. He can still afford the ice cream. But the point out of all this is, I think, number one, what you just said, nobody really can pick individual companies for the long haul. Now, Warren had a period of great outperformance. Remember, Warren has another advantage when it comes to that you do not. He gets to get in and run those companies. He gets seats on the board.
Exactly.
He gets kind of involved in a way that you're not going to if you own a few shares of, let's say, Bank of America. You don't get that involvement. Number two, the money that he puts in is substantial. So beyond just the control, the fact that he has been part of management of these companies. And he would admit, by the way, that the period of time where he had the huge growth, the huge returns, nobody, he doesn't believe, will match that again. He said that publicly, that he doesn't think that could happen into the future.
And I hate to say this about a nice old guy, and he is a nice old guy. Everything I've read says he's a nice guy. But he sounds like he's a hypocrite in a lot of ways. You know, he says, yeah, buying individual stocks doesn't work. Buy an index, although I'm going to buy a lot of individual stocks. Oh, and don't time the market, although I'm heavily in cash because I'm timing the market.
But didn't you ever tell your children not to overeat and to get exercise and then lay on the couch and eat ice cream?
Absolutely. I'm as big a hypocrite as anyone.
Just checking.
But it just, we've got to quit thinking that these guys are somehow special.
That is a fair point, by the way, because that's what people expect from not just Warren Buffett, but from anyone who's held up like they know something that others don't. They don't. Warren would be the first to admit that. He doesn't know the future any better than you do.
855-935-TALK. TALK. 8255 is our number. If you have a question about money, if you're looking for a little guidance in your future life, give us a call. We'd love to help you out.
Tom and Don are talking real money.
If you're sick of your self-interested financial advisor and are looking for a 100% fiduciary low-fee investment advisor, call my firm Vestory at 800-386-3004 or visit us at vestory.com.
For your real life and real future, Tom and Don are talking real money.
Hello again, and welcome back to Talking Real Money. I'm Don, along with Tom, and we were just reminiscing about World War II.
No, we weren't actually reminiscing. Yeah, that's right. We weren't.
You were. So. Tom's really excited about his Soviet Storm Sunday.
Yeah, I don't know. I guess I don't have a whole lot on the list, so that might be take up a bit of it. So for those of you who are World War II historians or have an interest in that, I like the series. It's made by the Soviets. So
the Russians.
It's kind of it's kind of a weird. The production technique is kind of odd.
Yeah, it is. They use computer animation combined with
and then they
go
into
action
live action. It's kind of anyway. The story is interesting because I don't know the story well. That's the part I like.
You know it from the Western Alliance.
Yeah, I don't know much about
the British American Alliance.
Yeah.
All right. Well, where were we? Oh, we're talking about money here on Talking Real Money, not World War II. 855-935-TALK is our phone number, 855-935-8255. Although, I read an article today, speaking of the war.
Yes.
What year did the B-52 bomber come out? You know this, the Boeing B-52
The year that
bomber.
It actually began service, or the year that, I think it was like 58 or something.
No, 52.
52. There you go.
52.
Wow.
There was an article today that said the Air Force is buying new engines for every one of the B-52s to enable them to fly until, get this,
2050?
2050.
Yeah, I mean, they've parted those things out, and they put all new avionics in them. I mean, it's a pretty interesting project.
Kind of 100-year-old plane. That'd be like, flying around in a Wright Brothers plane.
They've replaced a lot of stuff on them, so don't worry about them falling in the sky. There's still like 85 or 90 of them, I think.
Yeah,
still
there's
a lot.
A bunch of them left.
Yeah, great
plane.
Although
one flew a sort of a show mission over New Orleans the other day, and a panel fell off.
Oops. Yeah.
Didn't hit anybody. 855-935-TALK is our phone number.
You're trying to say the show is bombing? Is that what you're saying?
8255. No, I thought we were doing incredibly well the last hour when we had Paul Merriman with us swimmingly.
So we talked a little bit about Warren Buffett, Berkshire Hathaway, $50 billion. I mean, that's something worth noting. Someone wrote us, though, and said, hey, why do you recommend the Vanguard Total World Stock Index, VTWAX? One mutual fund. It holds 8,800 stocks globally. You get it for, I always forget, is it like 25 basis points? It's very inexpensive.
Now, it
widely
is 10
diversified.
basis points.
Wow, okay, I got to remember that.
0.10.
I mean, that's pretty doggone cheap. But her question was, why do you recommend that when since inception it's lost 1.02%? Why would you recommend such a fund? What's wrong with you
I'm
people?
looking right at the number. It's negative 1.02%.
She's right. The problem is, and this is one of the issues I have a bit with Morningstar. If you go to Morningstar and you type that ticker in, it shows you performance going back over a number of years, but what it doesn't show you is that this actual Admiral shares of this fund have only been around since February 2019. So since February 2019, you are down about 1% since inception. Okay, and that's another thing to pay attention to when you're investing. I don't think that's the right thing to be looking at. What the right thing to be looking at with the mutual funds you own is what asset class you're trying to purchase, right? Are you trying to buy large companies? Are you trying to buy small? This one gives you the opportunity to buy the whole market at just 10 basis points.
Right, but you are overemphasizing large companies. You're getting some international, which for a lot of people is they dislike it only because the international markets hadn't done as well in the past decade as the U.S. markets. But this is again that we run into this a lot. Talking to clients and the like. Well, what are your returns? We just care about your returns. What are your returns? That's the wrong question. You can get really ridiculously high returns at times, taking ridiculously high risk. But you love the return and you hate the downside. And that's something I keep trying to get across on this show is that downside is not something that's theoretical. Risk is not theoretical. For risk to
it was
provide
for about
return,
10 years.
I know it felt theoretical, but the reality is risk is something real. It is going to happen to you. That's why we say over and over and over and over again, you will lose money. We just don't know when.
Well, and that's another, I'm not a fan of that because you don't actually lose the money till you sell something.
But, okay,
your portfolio will decline in value, yes.
Yeah.
No question. And by the way, for those of you still working, and I'm happy for you because I'm among you, and I'd like to be for a long time, this is a great time to be buying every 2 weeks into your 401k. I just had somebody write me the other day, is this a good time to be selling stocks and buying bonds? No, it's quite the opposite. You'd be selling the bonds and buying stocks.
As a matter of fact, we got a question very similar to that.
Oh, well,
just
please
sent into Don@vestory.com.
Okay. You don't want to call? Do that.
Mailed in. This is about asset classes, and it says, "Hey, Don, I currently have 4 funds in my IRA. Here is the mix. 25% large cap, 25% mid cap, 25% small cap, I would assume all U.S., 25% international. In your opinion, is this a good approach? I've been considering selling off these equities and switching my approach to a one-fund portfolio, and I would purchase VTWAX, Vanguard Total World Stock Index.
Do they hold for those asset classes?
I'm not. Excuse me?
Okay.
I haven't finished.
Sounds like home. Okay.
My main concern is whether or not to do, this is the important part. My main concern is whether or not to do this now or wait for the market to rebound.
Oh, one of those
I don't want to
deals.
lock in any losses. I just can't seem to wrap my head around this.
People have, there is that tendency, too, to think, well, I don't want to do anything now.
Because I'll lose money.
I'll lose money. Well, but won't you be moving it from that level to the one fund that holds similar asset? I mean.
And that has also lost about the same amount of money.
And then in terms of that overall, I think there was a guy on last hour who said, think of the billions and trillions of dollars people have lost trying to time markets.
Mm-hmm. This is, it's so simple. This is a lateral move.
That's the point. You're moving.
This is like saying, I own General Electric and I'm going to sell it at a loss and buy General Electric.
And I'm going to go on a limb here and say for most people, it probably does make sense to just own VTWAX.
Right.
You don't have to do anything. It's all done for you. You don't get exposure to small and to value the way we think you should, especially internationally. And even the amount you have in that it's going to be small. It's going to be rather insignificant. I'll put it that way, so that you will miss out. We believe you have missed out on returns of small. But if you just don't want to do anything, you just want to set it there. You don't want professional help. I think it's a great solution.
Right. Now, bear in mind that the portfolio you have right now with 25% large, 25% mid, 25% small is going to skew you toward those riskier asset classes, which should, at least if history's a guide, it would have increased your return. You would be a little low on the international. If you go with the VT Wax, you're going to get a nice mix. They'll do the rebalancing, in essence, internally. You don't have to do it. And I really believe it is an absolute lateral move. It's so close it doesn't matter.
Tom and Don are talking real money.
Download the advisor interview form and find out if your advisor's a fiduciary at talkingrealmoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
855-935-TALK, 855-935-8255. If you have an issue that involves money in any way, give us a call. We'll talk about it. You have a question, you're not finding the answer to it, or if you just want a second opinion, give us a call, 855-935-TALK, or send me a question, don@vestory.com, and I'll answer it on the show. That's why we answer those on the show.
Yeah, that's not going to be one-off. Go ahead, hit us with another one.
I don't have another one.
Oh, that was that.
I thought I had another one, but it's really not a question. So
all right, well, then let me touch on
it.
something that seems to be somewhat of a theme here, because it came up last hour. Somebody saying, yeah, I think this might be a good time to buy oil. And we do. It might be, it might not. I have no idea.
No, it was a good time to buy oil when you could get paid to buy it.
when you had to have a place to put the tanker out and
when
back.
you got $35 a barrel to buy it.
You're going to be amazed when you hear what happened in the month of March, the first quarter, actually. A lot of you went out and opened trading accounts at TD Ameritrade, E-Trade, Schwab, because you can trade stocks free.
Yeah. Why would you want to trade stocks?
Well, because you can trade them free.
But why would you want to trade stocks?
You trade them free.
Oh,
they don't cost
well,
anything.
Thank goodness. It doesn't cost me anything until I pick the wrong stock and lose everything.
Well, I'm getting to that.
Oh,
Because
okay.
I love this
Just
quote.
checking.
I'm not picking on anybody, but I can't help it when I read these quotes. This is from a 34-year-old who said, I jumped in March. By the way, it was an astounding number. Ameritrade, 608,000 new accounts in the first quarter. E-Trade, 336,000. But Charles Schwab, 609,000 new trading accounts in the first quarter. Wow. But here's a quote. 34-year-old said, I'm buying some stocks. And here's what he said. I feel like everything that I buy, I watch pretty closely. And if it's something that's not doing well, I generally try to put that money into something that is doing well instead. So you buy something, and then it goes down, and then you say, whoa. No. I'm not going to keep that.
I'll sell that.
Sell that and buy something that's doing well.
So wait, let me parse that a little.
Please.
Okay. So I buy XYZ stock today at $20. It goes down to $5. $5 I'm okay with. I'm going, okay. $5 could just be temporary. It'll bounce back. Goes down 10. I go, I'm going to sell it. Then I buy ABC stock that in the past couple of weeks has gone from $5 to $10. So I buy it at 10 because it's already gone up, and I sold because it had already gone down. Isn't this because what if ABC stock just had its complete run and it goes back down to $5? This is stupid.
Well, and I want to finish the thought around this.
I just want to say this
I'm going to
guy's
let you
stupid.
say that. Yeah, that's not a good way to invest. But beyond that, buying individual stocks, we've touched on this many times. Number one, 90% of the trades, 90%, 9 out of 10, are made by institutions. Do you think that you know more about an individual company or that they know more? Well, I'm going to just go out on a limb and say they do.
And when it comes to trading, sometimes you have to do it fast.
Yeah,
too.
that's right. Individual stocks can go to zero. If you own VT Wax, it would take something very cataclysmic for it to go to zero. I mean, you wouldn't care about money at that point either.
You mean an extinction event that kills us all?
Something like that, where money really is pointless.
Oh, I'll be dead and I'll be going, but I lost everything.
Where's my index fund? And here's the other part. The institutions, The really smart
Yeah.
people that have all the advantages, spend billions researching companies, they don't have a long-term track record of doing better than just owning an index fund. They don't. And yet you're buying individual stocks, trading them, because I just heard oil could go right back up. Whew.
Mm-hmm. Well, but here's the deal. Traders, people who do this for a living, there are those who make money.
Oh, yeah.
But they make money by trading very, very quickly. They take advantage of tiny little penny or less differences in the price of stocks on two different exchanges. The kind of games you can't play. You cannot even play in the same... You can't even be in the same country as these people, much less the same league. 855-935-TALK is our number.
Tom and Don are talking real money.
Do you know what your investment risk tolerance is? Take our free no-obligation risk quiz at talkingrealmoney.com.
Reality radio for a really great future. We're talking real money.
Our phone number again is 855-935-8255, 855-935-TALK. I'm Don McDonald. That's Tom Cock, and you are people we just adore. Thank you for being there, and please tell your friends, listen to the podcast, too. We do, in addition to the show, there's a podcast pretty much every day. Not only this, but I also turn the Como features that I do weekdays into little mini podcasts. So there's a lot of stuff online at talkingrealmoney.com or your favorite podcast service. Scott, you're up next. Welcome to the show.
Hi, Scott.
Hey, how you doing?
Good. How can we help you today?
Well, I just retired from a company, and I've got like about $300,000 in a 401k, and my question is, should I pull it out and take a tax hit now because of possibly much higher taxes in the future?
I'm going to say no, but
no.
My reason may surprise you. It would make more sense. How old are you?
I'm 65.
Yeah, I mean, you don't, as you may know, now under the Secure Act passed last year, you're not required to take any money out and pay tax on it until age 72. But I don't know anything about your tax situation. However, generally speaking, you wouldn't want to take any of that money out until you had to. Part two is you'd want to do it over a number of years, so you only take a certain amount of tax hit per year. If you take the whole 300, you're going to move up a couple brackets there and pay a higher percentage of all that money. It would not be the right way to do this.
The other thing that springs right to mind, Scott, is the fact that if you can afford to pay the taxes on it today, well, then why not take a little every year over the next 7 years and recharacterize that, pay the taxes on a portion of it, and then put it into a Roth that will continue to grow tax-free for almost ever.
And you don't have to take it out at that point either. That would be called a Roth conversion strategy, which may make sense. Again, we'd have to look at your tax situation and make sure you didn't move up a bracket and that you had money outside of that 401k to pay the tax. You would not want to pay it from the 401k.
I thought you were limited on how much you could put into a Roth per year.
You are, but this is different. A Roth conversion is a different animal. In other words, that is a Roth contribution, which is limited, yes, in term. For the first limitation, by the way, is the amount of income you have in a year. The second one has to do with your tax situation. But in this case, you could convert all of it to Roth. It'd be very unlikely you're going to want to do that in 1 year because it's going to be very expensive.
Yeah, I would not do it in 1 year.
Yeah, so,
no way.
But getting a little help there would be a good idea. Maybe from a professional before you run off and just take that money out and pay tax on it. I'll put it that way.
But, and the other part of this is you're kind of playing a game betting on the future. We do not know where tax rates are going to go down the road. Yes, I can see why you might think that they will go higher, but there are also scenarios you could imagine in which they don't. And so the best thing you can do is expect the worst and plan for that. But don't do something rash today that hurts you immediately if there's any way to avoid it. And Tom just shared a couple of the ways you could avoid that. So,
thank you very much for your call, Scott. Appreciate it.
Thanks for the call, Scott. 855-935-8255 is our phone number. And the call is absolutely free. We'd love to hear from you. Roth conversions really do, particularly after we've had a decline in the market, they make more and more sense.
Yeah, I think right now is a good time to be looking at all that. If your portfolio is down 10, 15, 20%, sure. But again, those rules still apply. You don't want to push yourself up a bracket. You do want to have cash to pay the taxes. You don't want to pay that out of tax-deferred money. And again, once you start getting, and no offense, because I'm in my 60s too, once you start getting into your 60s, unless your income goes down quite a bit, it starts getting real iffy about whether or not you really want to make those conversions.
Although, Scott does raise an interesting point, and that is, with all of the deficit spending, is there a chance that we could be looking at higher tax rates? And even some folks in their 60s who have been great savers and are going to work into their 70s and are continuing to build wealth and might be in a higher tax bracket in the future, it might pay to sit down with your accountant and do a little tax planning. Because
I would only take tax rates as they are today. The rest of it would be purely
Expect
speculation.
what they are. But the fact of the matter is, you might want to look at what you have. If you're a great saver, you might be in a similar or higher bracket in the future. There are also some estate planning advantages in that your spouse can carry that on forever tax-free.
Tom and Don are talking real money.
If you're sick of your self-interested financial advisor and are looking for a 100% fiduciary low-fee investment advisor, call my firm Vestory at 800-386-3004 or visit us at vestory.com.
For your real life and real future, Tom and Don are talking real money.
855-935-TALK. Give us a call anytime, 24 hours a day, 7 days a week. We'll take your questions and answer them on the podcast if we don't do them live on the show. And Ted, you're next. Welcome to Talking Real Money.
Hello, Ted.
Hi, how are you?
Good.
I had a question. Was modern portfolio theory, which I understand was developed by Henry Markowitz, is that from the 50s? I mean, a long time ago. And how does that dovetail with, like, the work of Eugene Fama and Kenneth French?
Oh, boy, you're really speaking our language here, Ted. Is this a setup of some kind? Does somebody put you up to this?
Is that way
back in the 50s?
Pardon?
Way back,
back in the 50s?
For Don, you have to say 1950s, by the way, just so they know it's not the 1850s.
Hey.
Modern portfolio theory, which holds, Don?
That the expected returns are based on the level of risk you take. And Fama and French subscribe to the modern portfolio theory. They
have done work well beyond that, but it does. I think you used the word dovetail, but yeah, I mean that's where it began. This whole work that Fama and French, where they dug into these stocks from way 100 years ago and how they performed. Does it make sense to own more of a particular type of stock? Like they found owning smaller companies made more than large, et cetera, et cetera. Is that what you're looking for?
Right. Because I've listened to you and Paul and looked at Paul's research and listened to you guys for years. And I do know that, and I understand. So like your firm and other firms and even Vanguard, like their personal services, they would probably kind of go that way. That's how they would invest, diversification.
Yeah, Vanguard would not have the tilts that Fama and French have developed.
They don't subscribe to the Fama and French theories. They do subscribe to MPT, to modern portfolio theory, and that creation of that what is called an efficient frontier, a portfolio that gives you the best expected return for a given level of risk, but they don't overweight asset classes, which Fama and French, that's the addition they made to that. Because basically Markowitz said you want to build the best portfolio for a level of risk given the amount or return, given the amount of risk you're willing to take. Well, Fama and French took that further and said, we find that there are asset classes that you can use that you should overweight, because not only do they add return, but they also have a modicum of non-correlation with other asset classes.
And by the way, they've been right the last month. They've been wrong the 10 years prior to that. I mean, small and value did underperform.
The 20 years prior to that.
Yeah, so it goes off and on. But if you go back as far as you can really look at the dog-eared, records of stocks, to the 20s, I think you find that smaller and what they call value firms have made more than big growth firms over time.
And you would say your firm uses dimensional funds, and they
Correct.
have more even better than Vanguard. As
Yeah,
far as
well,
the
yeah,
value.
the better, yeah, different. I mean, the performance has been better, again, over a long period of time. Not every year.
Right.
Yeah.
Vanguard does not do asset
No,
tilts.
they
We
simply
do
own.
asset tilts.
It's different than indexing. That's the way I'd put it. Indexing is truly, if you own the Vanguard 500, you have those 500 stocks in the percentages they make up in that index. Dimensional purposely does not own it that way. That's how I'd put it.
Okay.
Thanks, Ted.
Okay. Thank you very much.
We appreciate your call.
Yeah,
Take care,
really
sir.
do.
Bye-bye.
Great call.
Marty, you're up next. Welcome to Talking Real Money.
Hi, Marty.
Hi, how are you?
Great.
Good, Marty. What's
Good.
up?
Say, I have $150,000 to invest, and I don't know how to do it or what to do with it.
Well, I'd propose a great lunch somewhere, but there's nowhere open that has a bottle of wine anymore. I mean, you can't go out for a decent meal, so let's not do that.
Are you asking
Not
Marty
even-
out on a
not even
$150,000 date?
That's going to be something fancy, doggone it.
Yeah. You are.
$1,000 date.
Yeah.
You're an expensive
I think
date,
big.
Thomas.
I think big. It doesn't
Yeah.
work out, but I think
What
big
do
anyway.
you want this money to do for you since he's not going to be serious?
Well, I would like it to make some money for me.
Good. Okay. And
I-
what do you need it to do for you in the future? Is this money you need to live on at some point, or is this going to
No.
be money that's sort of
Well-
just there in case?
I might have to live on it on some of it. Depends upon what happens to Social Security.
You're okay on Social Security, so take that one off of the
Okay.
table.
All right. So then I'm fine. I own my house.
Yeah.
I own my car.
So this
and I
may be
don't
left
owe
to somebody
anybody
else.
A red cent.
This may be left to somebody
Pardon me?
else. You may leave it to a
Yes.
charity or a family member.
First step.
Correct.
First absolute step. Go to talkingrealmoney.com. Take the
Okay.
risk quiz.
Will
Okay?
do.
When you take
Will do.
that is going to give you a portfolio, an asset base from which to work. It'll say you should have X amount in stocks and X amount in bonds. To make it simple, what we suggest most people do to keep that process simple is once they know their risk tolerance is that the stock portion be made up of Vanguard Total World Stock Index and the bond portion, well, we have a few choices, but generally the Vanguard Total Bond Index is
VBLTX.
yeah.
Then you just balance between those two. That's that. Your expenses are very low, and the money grows over time with some amount of volatility you got to live with. That's the way it goes.
Okay. So stock Vanguard total.
Mm-hmm.
Yep, VTWAX.
Yeah, VTWAX, VTWAX for stocks.
V is in
V
Victor.
as in Victor.
Victor, thank you. For stocks. Okay.
And then
The bonds would be
B
VBLTX.
is in baby.
No, V is in victory.
B is in baby.
Yep. L as in Larry. T as in Tom. X as in X-ray.
Got it.
I used to say xenophobic, but they get mad at me for that, so I'll go with X-ray.
Okay.
I think it's as simple as that. Isn't it VB?
You gave her the Vanguard Long-Term Bond Index.
gosh,
That's not the right one.
Wrong ticker.
Hold on, let me look it up now.
We have one more call that we want to try to get to.
Yeah, hold on, I'm going to give her this.
No, we don't.
Oh, we don't? Okay. We don't then. Hold on. Vanguard Total Bond.
Isn't it VBLTX? They changed it. This is one of
No.
the problems we run into, Marty, is they mix them up on us, things we've known for a long time.
VB. Oh, you had them. You transposed two letters.
Shocking.
That's what I thought.
Okay.
VBTLX.
VBTLX. That is one mutual fund
Gotcha.
that holds several thousand bonds in it at a very low cost.
And the other is a mutual fund that holds several thousand stocks
Almost
at a very low
10,000
cost.
stocks, 9,000.
And then every year you rebalance to get back to what your target.
Yeah, if you said
Portfolio
60% in
mixes.
stocks, 40% in bonds, you'd rebalance back to that percentage.
There you go.
That's my thing to figure out.
Well, that's why
Yes.
you're going to take the risk quiz to determine who you are around money.
Yes.
Then
yes.
you can
Either
work from
that,
there.
either that, or you have to go to somebody else and let them do it, and you have to pay them to do it. This is
I
cheaper
understand.
if you do it yourself. Okay?
Okay, so then when it comes down and I check it in a year, how am I going to know what to do?
You'll look at it and go, well, is the stock portion higher or lower than where it was? If it's about 5% off, you go back to that 60-40 or 50-50 split you started with at the beginning of the year by selling a little of the stock and buying a little of the bonds or vice versa. Thanks for the call.
Tom and Don are talking real money. We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That's a wrap.